I might just start, if I can, with a show of hands. How many people here are excited about hearing about fixed income? Thank you. There's one. There could be a bottle of wine at the back there. How many of you are here today because you wanted purely to hear this session about fixed income? Brilliant. That's 2 bottles of wine now, John. I won't ask any more questions. You'll be bankrupt. The big problem with fixed income is it has a bit of an identity crisis. It's not exciting. It's not sexy. It doesn't get its own spot on the news. And so we really don't think about it too much. It sits in our portfolios. It's a set and forget strategy. And you just expect it to do what it's meant to. I don't think the fixed income market's really helped itself, because over the past decade we've seen this incredible proliferation of complex and really structured new fixed income securities, and they've got names that are like code names, so RMBS, CLOs, CDOs. It's almost as if there's a secret language that we're not really meant to understand unless you're on the inside. What I want to do today is try and avoid any of that jargon and just try and simplify it, because fixed income is really, really important, and it's really showing us that at the moment. And what I want to cover off is a couple of really key concepts, so that when you walk out of this door, I hope you have a better understanding. So to do that, what I'm going to do is just touch on 3 main things. I'm firstly going to talk about the difference between fixed rate securities and floating rate securities. I'm then going to talk briefly around the importance of credit quality, which I'm sure you'll all have a pretty good understanding from recent events. And then thirdly, I want to talk about how we at Perpetual like to invest in fixed income. When we look across the entire fixed income landscape, most securities can be categorized by 2 particular things. One is their sensitivity to changes in interest rates, and the other thing is the amount of credit risk that they carry. And this, by looking at this chart, it gives you a very good understanding, or a pretty good impression, of how certain securities will perform in certain environments. So let's have a quick look at these 2 concepts. So first of all, this concept of interest rate sensitivity or duration. I think I'll try and keep that to the one technical term that we keep in this, duration. Broadly speaking, there are 2 types of fixed income securities. There are fixed rate securities and there are floating rate or variable rate securities. Fixed rate securities tend to be issued by governments and semi-government organizations, and what they do is they pay a fixed coupon or a fixed interest rate to you, and you get a fixed amount back at maturity. On the other hand, floating rate securities tend to be issued more by corporates, and as the name implies, they pay a variable rate of income. The income that they pay is typically referenced against a benchmark, so they talk about a spread over a cash rate or a cash benchmark. Now, the key difference to these 2 types of security is their sensitivity to changes in interest rates. Floating rate securities have none, or little or no sensitivity to interest rates. So if interest rates go up, the capital value, the value of that security will not change. And the reason is because they're referenced back to a cash rate. So you imagine the RBA, let's say, lower the official rate. That will be reflected immediately in cash. So the security almost resets immediately, and it will continue to move in lockstep with changes to the official cash rate. Fixed rate securities, however, are slightly different. They can be very sensitive to changes in interest rates. And let me illustrate this with an example. Imagine today you have you put $10,000 into a term deposit. Let's say it's a 5-year term deposit and it's paying you 6%. So you're guaranteed to be getting 6% for the next 5 years. Let's fast forward 12 months. Suddenly, the RBA over that 12 months have cut interest rates, so now the market rate is at 2%. You've got the security that's paying you 6% guaranteed for the next 4 years. If you could trade that security, what do you think would happen to it? What would have happened to its value? It's paying 6% guaranteed, the market rate's 2%. It's gone up, exactly. So the point being that you've got this inherent sensitivity. You've got a guaranteed rate locked in for a period of time versus a market rate that's much lower. And that, in essence, is the important relationship. So any fixed rate security will change in its value depending on the direction of interest rate changes. Equally, if the RBA raised interest rates, say they got to 8% in 12 months' time, that security is suddenly worth less because it's only paying 6%. You could get 8% much more easily elsewhere. So I guess just to try and illustrate that quickly, we've got a fixed rate bond, we've got those two scenarios. The top one here, so interest rate rises, what happens? The value of it falls, so that's the example we've just used with a term deposit, but the income remains the same, and vice versa. If the interest rate goes down, that's the second one is the example. Interest rate falls, your capital value will rise, but the income remains the same. So this concept of interest rate sensitivity or duration, it's an important concept, but it's also something that can be valued and calculated. And to give you an example of this, if, for example, a bond had a duration, so a sensitivity of 3 years, and I don't want to get too technical here, that acts as a multiplier to a change in interest rates. So let's say that interest rates go up by 1%. That means that the value of that bond will go down by 3%. So it's got that relationship. If interest rates go up by 2%, the value of that bond will then be down by 6%. So it's almost an inverse multiplier. That's a really, really important concept. And I think the message here I want you to take away is that if you've got bonds that have high levels of sensitivity and you see sharp changes in interest rates, and particularly if they're unanticipated, what happens is you're going to see quite a lot of volatility in the value of that bond. And I guess this chart really just tries to explain it. So we've got a fixed rate bond here that lasts for 3 years, 3 years to maturity, and it's paying 6%. You know at the end of it you're going to get a fixed value. You know through the life of this bond you'll get this consistent agreed 6%, but what you get along that journey, if there are changes to interest rates, is volatility. So the point here is that fixed rate securities can be volatile when interest rates change. When we talk about floating rate securities, they don't have that capital variation. So if we see interest rates rise, it's not pointing any longer, the capital value remains the same, but the income rises. So the income goes in line with changes to the interest rates. Similarly, if interest rates fall, then the income falls. Another point I'll make about floating rate securities is they can act as a very good inflation hedge. And the reason is because their value goes back to the cash rate. And think about it, the cash rate, which is set by a central bank, is very often a reflection of inflation policy. So if the central bank's concerned about inflation, they'll adjust the cash rate, which will be immediately reflected within the security. So they offer you a good hedge and they offer you lower volatility. The second principle I was just going to touch on is that of credit risk, and I'm sure it's a phrase that we've heard probably too much of over the past 3 years. So what is the main principle here? Well, credit risk is really the risk of not getting paid your interest and not getting your money back at the end of your term. And broadly speaking, the higher the quality, the higher the credit risk you've got, or sorry, the higher the credit quality, the more likelihood you have of getting your money back. This just puts it into real life examples. So we've got 30 years of data here, and what we're looking at is from left to right, we've got the highest AAA credit quality going all the way to sub-investment grade over here. So it's 30 years of real life data, and it looks at the cumulative default rates over a 15-year period. So what's the experience been? Well, the clear message here, far left-hand side, the highest credit quality on any 15-year cumulative period over the last 30 years, defaults have been incredibly low. And what you see is as you move down the credit spectrum, so you take more credit risk, you see that defaults will rise exponentially. There's another interesting point in here, and it's one that I can't actually explain. And it's probably quite difficult to see. The red or maroon bars represent the global default experience over this time period, and the blue represent Australia and New Zealand. What you will see for most of these different credit bands is that the Australian default experience has been lower in a number of occasions by quite a margin than the global experience. I don't have an answer for that. Jonathan might do. It's a curiosity, but it's one of the reasons that we like to focus first on Australia when we're investing in credit. So in terms of taking those main concepts about managing risk and what sort of things you're exposed to with your fixed interest, how do we at Perpetual like to think about it? Well, I hope you don't mind indulging me for a couple of minutes, but I'm going to talk about one of our particular funds, the Diversified Income Fund. It's our flagship retail fund, and what it does is it really embodies a lot of our investment philosophy within one process. So what do we do? Well, on the left-hand side, there we go, we're back. So what do we invest in? Well, predominantly Australian floating rate securities. So floating rate securities have very little sensitivity to changes in interest rates. We invest in as high investment grade quality as possible. So we're right on the left-hand side of that credit risk spectrum. Mostly Australian, so we don't have to worry about any kind of currency hedging risks, and mostly short dated. And this is quite important. We try to lend as short time as possible because in a short time periods you've got the greatest visibility around likely outcomes. If I lend $10 to John for a week, the chances are his business is still running, he's still solvent, and he'll be able to pay me back. If I lend for 10 years, it could be a very different proposition. So the way that we think about lending money to companies is exactly the same. We've got a greater understanding of what can happen in the short term. We're certainly not going to be able to predict it, but we have a higher level of certainty. And so what that leads to is a low correlation to equities. So effectively, our fixed interest assets are doing what they're meant to be. They're defensive, they're secure, they're consistent, they're pretty boring. We have capital stability because interest rate changes are not going to impact the valuation of the securities. We've got a great level of liquidity. We can buy and sell these securities because they're high quality, there's lots of them, and we're able to pay regular income, which is one of our goals. And just crucially down the bottom here, no sovereign debt from Europe or the US, and very little currency. The outcome of the portfolio is really as a result of a four-stage credit risk process that's really, really, really rigorous. The first step here is around the risk appetite. So the first question we ask is how much credit risk do we actually feel comfortable taking with your money? There are four factors that our credit analyst team will, on a fortnightly basis, put scores on from -2, so very negative, to +2, feeling really positive. So we look at value, outlook, demand and supply, and market technicals. And for each of those, they give them a ranking. We end up with an aggregate credit score between -8 and +8. So that starts us off, how comfortable we are, what our risk budget is. So step number 2, we've got our risk budget. Where do we want to focus our investments? Are there sectors that we like or dislike? Well, we go through another credit scoring process that looks across the fixed income market at a range of securities, and we will do another similar credit scoring process to identify where we want to be. The next filter is what we refer to as our quality filters, and this relates to individual companies. We refuse to invest in companies, very similar to Tim, we refuse to invest in companies that don't have certain characteristics. So sound management, we want good quality leadership at the head of the firm. Strong balance sheet, we don't want high levels of debt, we don't want to see too much leverage within a company. We look for market leaders, people have competitive advantages for what they're doing, and a low susceptibility to risk. If all of their business is based in, let's say, the Soviet Union, you've got a high level of political risk there, amongst other things. So we want to make sure these are broadly well-diversified businesses. And so once we've gone through that filtering process, we actually get to the point where we start looking at companies and saying, right, where do we really want to invest? And that's the portfolio construction and monitoring. That's just an example of the chart. I won't spend any time on that, but that breaks down the fixed income market and how we score them. So where's our valuation today? Well, we're neutral today. We're rating is 0, which is rather boring actually. I'd rather have something more exciting to tell you. But that's recently ticked up from -1. So we turned negative at the end of June for the first time in 18 months. And what that led us to do fairly quickly was to de-risk the portfolio. So we recognized on the outlook for credit was deteriorating. We wanted to make sure that we weren't exposed to undue risk. So we did 3 things at the beginning of July in the portfolio. We increased cash balances from about 3 to 8%. We increased the amount of senior debt within the portfolio to just over 85%. So I talked about in the capital structure, I didn't actually, within the capital structure, that's as high as you can be as a debt holder. And what that gives you is lower relative levels of risk, and also importantly, if a company goes into default, you get paid first. So 2 things that we found really important. And thirdly, we reduced our exposure to banks and financials. And the reason we did that from 30 to 19%, the reason we did that was because when you see sovereign crisis or sovereign issues, they tend to be most closely reflected within the banking and financial sector. So we wanted to withdraw that level of risk.